Hi guys, and welcome to our podcast. Today we're going to understand how to refinance your student loan quickly and easily. With the increasing demand for high-profile employees, many people decide to pursue a degree or further qualify and continue their education. Being a student, however, is not easy. Even though there are plenty of opportunities for students to work while studying, money is still a problem. The tuition fees are sometimes enormous. This is the reason why so many people take out student loans to support themselves and pay their annual fees. U.S. 2016 statistics show that the number of people having student loans is approximately 43.3 million. The total amount of student debt is $1.41 trillion, and the average number of graduates who have student loans is 60%. This data only confirms the importance of student loans nowadays. Many people, however, have problems with repaying their student debts or opt for lower interest. Let's look at the options you have to refinance your student debt. So why would you consider refinancing? Before you sign the papers, you have to be aware of your purpose. What's the reason you're doing this? What do you want to achieve by refinancing or consolidating your student loan? Below you can find the 7 most common reasons for people to do it. Number 1, lower interest rate. Maybe this is the most common reason for people to take out a new loan. Better interest. If you can negotiate better terms overall, it would be great. Number 2, reduce the total amount of debt. If you manage to get lower rates and shorter period of repayment, definitely you will decrease the total amount of money you owe. This move will be wise only if you can afford the monthly payments. Number 3, pay less each month. By lowering your interest rate, the chances are you'll end up paying less each month. If you manage to prolong the period, even less so. Be careful though. Expanding the period of the loan will definitely result in increased total costs. Number 4, make it simple. Maybe you have a couple of student loans. This is a debt consolidation where you can combine several student loans and make it simpler and easier to manage. Let's say you'll only have 1 payment a month, not 3. Number 5, free yourself of cosigners. It's terrible to have problems repaying your loans and have a cosigner at the same time. If you refinance your student loan, you might remove the cosigner and be free. Number 6, no fees. Usually refinancing loans shouldn't have application and origination fees. However, some of them will charge you and you have to look carefully before you sign a new contract. Number 7, change your lender. Maybe you're not happy with your current bank and you want to change the lender. They, on the other hand, might give you better terms on your new loan. It's good to know that there are mainly 3 types to do it, depending on the loans you have. The first one is via federal student loan consolidation. Federal student loans are loans funded by the U.S. government. If a person has several of these, they can qualify for a federal student loan consolidation. You will not get a random interest here, but rather a weighted average of the loans combined. This means that your new interest rate might be lower than the one on some of your old loans, but it could also be higher than some. As any other loan, good credit score and record of payment is compulsory if you want the bank to approve you. The second option is private student loan consolidation. This is for borrowers who have only private loans, which are given by a lender, a bank, a credit union, etc. This consolidation is possible only if a person has private student loans. In addition, a good record of payment and credit score, which determines the interest of the new loan. The last one is student loan refinancing. This option is very similar to the previous one. Using it, you can consolidate your private student loans to pay each month. There's one major difference. Here you can work with lenders that offer to consolidate both private and federal student loans. As previously discussed, depending on the type of student loans, there are mainly 2 options, refinancing and consolidating. When consolidating their debt, borrowers can unite only one type of their loans, federal or private. For example, a student takes a consolidation loan to unite his federal student loans. Refinancing, on the other hand, combines both private and federal student loans. Only private lenders offer this type of refinancing. Why would you combine them? It would give a better rate, better terms, and 1 monthly payment. Refinancing your loan means that you will take out a new one to cover and pay off your existing debts. This, on the other hand, means new conditions and terms. Before consolidating or refinancing, know that the federal loans offer some special benefits. For example, forgiveness or repayment plans. You can also pause your payments for a while. Once you go for a refinancing, you won't be able to avail of these benefits. It's irreversible, so be careful when you refinance your current debts. Don't jump on taking new loans for the sake of lower interest rates. What if your current contract allows you to use some of the benefits you didn't even know about? Undoubtedly, a refinancing loan is the best and most effective option, but consider these. Sign up for automatic payments. This may reduce your rate by 0.25%. Paying your monthly installments on time for several months in succession might give you some benefits. People who have federal student loans are not penalized for prepaying their loans. Think about paying more some months and the term of your loan will decrease. Now that you know the basics of student loan refinancing and consolidation, it's time to ask yourself several questions before you proceed. This post can also assist you to ask the right questions. The first thing you should ask is, what's my ultimate goal? What do you want to achieve? The thing you want to accomplish most will shape your actions and the type of refinancing you'll get. It will dictate every step towards achieving the task. Another question is, what's the money you can afford? Be clear about it. Know your finances and plan carefully. What is the recommended amount of money an individual can dedicate to monthly payments? Here you need some maths. Calculate your discretionary income. This is what's left after taxes, Social Security, and basic living costs. Some claim it's usually between 10 and 15% of your total income. Dedicate 10% of your discretionary income to monthly payments. In addition, always try to find if you can get a lower interest rate. It depends on many factors, as you know, but usually federal loans offer a lower interest rate than private ones. The main factors determining your refinancing loan rate are your current loans rate, your credit score, your current terms and conditions, and your payment history. Another common question related to your credit score, and in a nutshell, is your credit score good? Before refinancing, you may have to take a look at your credit score. Nowadays, many lenders provide their customers with a monthly credit score. Just check your monthly statement. Also, there are websites that show your credit rating. Credit Karma and Credit Sesame are two of the most common ones. A great credit score can always guarantee better terms on your student refinancing loan. Don't forget to ask about the possible new conditions. Before taking the new loan, check what the new terms and conditions will be. For example, federal student loan consolidation usually offers between 10 and 30 years as a repayment period. Terms of refinancing loans range between 5 and 20. As regards to the interest, if you are consolidating your federal loans, you will get a fixed rate for the whole period. When it comes to private student loans, private lenders offer two types of rates, fixed or variable interest rates. Which one to choose? This is a hard choice sometimes because depending on the market conditions, you can either lose or make a profit if you opt for a variable rate. Fixed rate is definitely a safer option because it does not change during the whole term. Here you can better understand what is fixed and here regarding variable rates. It's talking about mortgage conditions, but the idea is the same. So when you have some information about your new loan's terms, conditions, and interest, compare with your previous one. Bottom line, before going to your lender and asking for a consolidation or refinancing, you have to be perfectly aware of your current situation. What's the reason to do it? Are you unable to repay your loans? Or maybe the high interest rate troubles you? Keep in mind that often financial problems stem from a person's spending habits and bad management. Instead of taking out a new loan, see if you can restructure your budget and expenses. Check with your lender if you qualify for some other benefits. If you really face serious financial issues, let's say have no job or other predicaments, then consider refinancing your consolidation. That's it for now. On our website, you can find more posts as well as refinance calculators and other financial tools. I hope you enjoyed it, and don't forget to subscribe to our podcast channel on YouTube. We would love to know the ways you refinance your student loans, so feel free to share them in the comments below.